Hello traders, Greg here with a market update. Okay, so today we do have a risk event, and that risk event is it's more than likely that the US government is going to shut down today, and that happens at 12 o'clock Washington DC time, so midnight in the US on the 1st of October. So that's going to be early afternoon Asia here. Now, with US government shutdowns, we have been to this rodeo before. So they usually do get resolved after a couple of days, but look, sometimes they can drag on for a couple of weeks. But the bottom line is that they do always get resolved. But okay, so how does this affect the market? Well, firstly, the Bureau of Labour Statistics is a government agency. So they won't be working. Tomorrow we're supposed to get initial jobless claims, and on Friday we're supposed to get non-farm payrolls. Now, obviously, the market is very, very focused on employment data at the moment. So the fact that the BLS will be shut down, we won't get jobless claims and payrolls on Friday, very important data. The market is going to be flying blind with respect to economic data, so that is an obvious big negative of this US government shutdown. Now, how has the market been trading into this US government shutdown? Look, the big standout 100% has been gold. Gold has been in a raging bull market. It doesn't really need another reason to rally, but obviously a US government shutdown is disruptive. It creates uncertainty, and obviously gold loves that. So we've seen gold, open at the beginning of the week around about 37.60, and we've seen in the last couple of days it basically rallied $100 to make new highs at 38.70. So yes, that raging bull market continues, and look, who knows? I mean, this could be at 4,000 sooner rather than later. Now, if we look at equity markets, equity markets have largely really ignored this US government shutdown. S&P and NASDAQ actually had a very strong close yesterday in the US session, and to close the end of September. S&P was actually up 3.5% for the month. NASDAQ was up 5.5%. So had fantastic runs in September, which is usually a pretty average month for US equities. Look, US equities are currently still trading up around record highs. So again, US government shutdown really hasn't played any sort of risk off in US equities, and probably largely, as I've mentioned, is the fact that the equity guys know that this that always gets resolved. As far as the currency space is concerned, look, the US dollar has been bid ever since the Fed cut rates a few weeks ago. And so at the start of this week, we've seen a little bit of US dollar weakness, so it's given back some of those gains, but haven't seen any large volatility or any sort of big moves there. Anyway, so just moving on, just a quick chat about the US labour market. And is it really weak, and does it really warrant aggressive Fed rate cuts? Now, post-COVID, the headline number for non-farm payrolls has averaged around about 100 to 150,000 each month. Now, that has dropped significantly, about 100,000, down to now averaging from about 0 to 50,000 gains per month. And that is really where the market has been worried about the labour market weakness, and why the Fed has given us that insurance cut and potentially will give us more. But the thing to note about why we're actually seeing the headline number drop so much is to do with Trump's immigration policy. Now, Trump obviously deporting millions of immigrants basically means that that's where we've seen the actual job losses come from. So it's not actually from employers, firing people or cutting back on jobs because of, say, a weak economy. So the suggestion is that the market shouldn't really be now focused on the employment number of non-farm payrolls. The new normal now for a stable employment market seems to be that 0 to 50,000 gains per month. But what the market really should be focused on is the unemployment rate. So the unemployment rate, and if we were to get those non-farm payrolls numbers on Friday, was expected to be at 4.3%. So we've only really seen the unemployment rate marginally tick up in the last couple of months. And if the unemployment rate were to stay around current levels between now and the end of the year, then that would basically signify that the employment market really isn't as weak as what the market maybe is worried about. And I'd suggest that then we might need a repricing of aggressive Fed rate cuts. So look, that is something to watch, obviously, as the months progress going into the end of the year, and a obvious risk if the market needs to reprice those Fed rate cuts. Okay, now lastly, just a trade I like is long Aussie. We had the RBA yesterday. They are obviously in no hurry to cut again. Obviously, inflation's back on the radar. Monthly inflation has gone from 2.1 to 3% in the last couple of months. That's not good. It's going in the wrong direction. It's hard for the RBA to cut when it's doing that. Obviously Aussie is a risk currency. You got risk at record highs with equities. Hard to sell Aussie when that's happening. Obviously Aussie is a commodity currency. Commodities are absolutely ripping as well. So again, that's bullish for the Aussie. And there's good technical support for the Aussie around that 65.5 level. It's building a solid base off that. So I'd imagine at some stage we're going to retest at 67 highs for the year, or the highs for the last 1.5 years. Breaking that further out, longer term, going into year end and early next year, I'd imagine probably 70% targets are certainly realistic. Anyway, be careful just over maybe some knee-jerk reactions today with headlines with the US government shutdown. Good luck, and we'll check back in with you shortly.